So guys, let's get started. Thanks for attending this presentation by Private Mortgages Australia. What I really want to do is get to give you a bit of an idea of, if you've never done any private lending before, a bit about how it works, but also get into some more of the advanced stuff and the nitty-gritty about how you can help your clients and when to use private lending and when not to use it, and even some of the things to look out for in the marketplace. So let's get started. So the first thing I want to cover is, this is our product fact sheet. This is the three products that we offer. The first thing you'll notice is that we do business finance. So we only provide loans that are non-coded, so they have to be wholly or predominantly for business purposes. Pretty much if it's a company that's borrowing the funds, it's fine. It's a corporate borrower and we can lend the funds. What we can't do is your mum and dad looking to buy their own home or do some renovations to their own home. Just makes it very hard that if it's a coded loan. The other thing you'll notice when we've got the first mortgages and we've got our interest rates. Now they're actually per calendar month, not per annum, because we specialise in short-term finance. So someone who needs money very quickly, but they only need it for a couple of months. So our term of our loans go between 2 to 12 months. So for us, a 12-month loan is actually a long loan. So our first mortgages are between 1 and 2.5% per month. Second mortgages between 1.5 and 3.5, and caveat loans between 3 and 5%. So, and you also see the amounts there in terms of how much we'll lend, and so they're the sort of the three products that we have. One of the other things I really want to cover, and it's probably one of the more common questions we get asked, is, that all sounds great. How much will you lend to my client? Now, what we break it into is obviously residential, commercial, industrial, land, rural, and development, but we also break it into categories. So you've got category 1, 2, 3, and 4 there. Now these are based on the Genworth financial, their postcode categories, and this is how they do it. So category 1, if you're not familiar with it, most properties are category 1. So your Melbourne, it might be your CBD and about sort of 45k out of the city. Category 2 is more probably your regional centres, and it sort of works down to anything. Sort of category 4 is whoop whoop, so something that's in the middle of nowhere, or it's it's a farm or something like that. And obviously, as you can imagine, we lend less on something that's a little bit harder to sell and doesn't have quite as ready market as you would in suburbia. The other thing you'll notice there that we've added in, that we only put in for our webinar presentations, is the maximum LVR that we'll do. So as much as we'll say, look, residential category 1, yep, we'll do 75% on that. We do have the scope, because we're private lenders. Private lending is all about being flexible and working something that's going to work for the client. So we will actually go up to 80%, depending on the circumstances. As long as it makes commercial sense for us to do so. It helps if they've got a really good exit strategy, that we can actually push the boundaries there. A great example, we did a transaction a couple of months ago, and it was actually a property that was in category 4 location, so in the middle of nowhere, and it was development, so it was incomplete security. So very few lenders would even look at that. Now normally we would only do a 50% lend on category 4 development. For that one, we actually did a 65% lend, and it's just because it made financial sense for us to do it. Okay, so he had a really good track history. We could see the properties; they weren't too far from being completed, and we had the ability to, give him some drawdowns to be able to finish those projects and sell them. So, it's all about, for us, and private lending is all about flexibility. So as much as we say, here's the locked-in amounts and figures, it's all about being flexible. But same again, it does have to be commercial. We can't suddenly do a 90% loan on some residential property. Now let's get into the fees and charges. So this is what I suppose the other costs we have other than the interest rates. So we have an assessment fee, and we charge between $550 to $770, and this is to assess the loan or the loan opportunity. This helps cover the cost of any credit checks we need to do, any sort of even just title searches, bankruptcy checks. There's a heap of different checks that we do, and even some of the time that we spend analysing a transaction to see is it something that's going to work or not. That is the only cost that the client will pay, right up to the point where we give them the formal letter of offer with the exact interest rate, fees, charges, everything. Okay, so there's no commitment that if they then pull out, they've then got to pay all these other fees and costs like we've seen with other letters of offer before. The valuation, we always do at cost, so there's no margin or anything like that. And the other thing that we do, we'll actually release the valuation to the client once the loan is settled. So if you like, your client can just send us an email, hey, can I get a copy of that valuation? For our point of view, they paid for it anyway, so more than happy to give it to them. The only other fee we charge is an origination fee. Some call it an application fee, and we have minimum application fees. Minimum origination fees based on the amount that they're borrowing. So if it's less than $100,000, it's a flat $4,400. And then it's a percentage. So the more they're looking to borrow, obviously the cheaper and cheaper it gets. Now, what we pay our referrers is 1/3 of this origination fee, or we allow you to mandate your client directly. So for those of you who don't know what a mandate is just basically an agreement with your client that they're going to pay you a certain amount of money. So you might have a mandate with your client that says, hey, you're going to pay me $5,000, once I get this loan through. Now we actually, if you're selecting the option where we pay 1/3 of the origination fee, we actually give you some scope for you to determine what the origination fee is. So as I said, we set the minimums, but you can charge whatever you like, knowing that you're going to get 1/3 of it. So that just gives people and our referrers and mostly mortgage brokers the ability to say, oh look, this is something I'm going to spend a lot of time on, therefore I'm going to charge a little bit more for this one because they want to get compensated a little bit more for the amount of time and effort they're going to put into the transaction. The other thing that's worth noting is any referral fees or commissions that we pay, they're always paid at settlement, so you don't have to wait a month or anything like that for it, and we don't do any clawbacks. So once you've got the money, it's yours and you can do whatever you wish with it. Put this nice little diagram in here. You can see the process, I suppose, of what we do. So as soon as we get an application comes in, our credit manager, Peter Cuskelly, he'll actually do the initial assessment. So we have a bit of a look and say, okay, what's the security? The LVR is fine. What's the general situation on it? And what will be issued is an indicative letter of offer. This indicative letter of offer have the indicative interest rate. So we'll say, yep, here's what we think the interest rate will be, and this is when we then charge the assessment fee. So once the client signs the indicative letter of offer and pays the assessment fee, that's when we'll complete all the rest of our due diligence and issue the formal letter of offer. Now, to give you a bit of an idea of timing, for us to do the initial assessment and get back to you with an indicative letter of offer, we do this really quickly. Okay, the reason that we're around and what we're here for is speed of service. So typically we'll get the indicative letter of offer out to you usually the same day, definitely within 24 hours, and at the moment we're averaging around 2 hours turnaround time, provided you've given us the full application form. So really, really quickly we can come back and give you an idea of exactly what the rate's going to be and the fee. And as I said before, and I just really want to stress this, is that the only fee the client will ever pay is the assessment fee. That's the only cost they're going to have right up to the formal letter of offer, other than maybe a valuation. And sometimes we can even do the valuation after we've issued the letter of offer. As soon as the letter of offer is signed, we get the mortgage documentation drawn up and we settle usually the next day. So it's a very, very quick process. And it's just allowing us to work with the client to make sure we're going to be able to deliver the time frame that they need. What I want to do is just quickly go through an example. This is an actual transaction we did, and we had an property investor. He had some experience, and he'd managed to find a little food works, and this is in country Victoria. And it was a distress sale. He able to pick it up at a really, really good price, where the valuation on the property, just the building alone, let alone the business, was worth $950,000, and he picked it up for $650,000. Now, the only reason he could pick it up for $650,000 is the owner was quite motivated to sell and needed to sell it very quickly. So he had to settle within 2 weeks. Okay, so there was no chance of him going and getting a traditional bank loan. But the other thing that complicated it is that the bank would only lend him on purchase price, not valuation, whereas we will actually lend on valuation, not purchase price, whichever is higher, which is obviously very different from the banks, which will do whichever is lower. So the postcode category was category 3. We actually lent him $665,000, even though he only bought it for $650,000. So the LVR on this one was actually 102% of purchase price, but it was only 70% of valuation. The interest rate we charged was 2% per month. The originator fee was 3.3%, and the term was for 4 months. Okay, so he needed the money really quickly, but only for a very short period of time. Now, one of the best ways to analyze a short-term offer or a short-term finance, and definitely the best way to compare other providers, is to almost forget about the interest rate. I know a lot of borrowers get hooked up on the interest rate, and what I suggest is to look at the total cost of the loan, okay? Because it's not just about the interest rate either. There's other fees and costs. So in this example, the interest rate and the cost for the 4 months to the borrower was $53,000. The originator fee was $21,945, and the legal fees were $5,500. So the total cost of this loan to him was $80,000. Now, the beauty of looking at this way is it's a really easy business decision for the client to make. This loan is going to cost me $80,000. Am I going to make more than that by doing this loan? Or am I going to lose more than $80,000 if I don't do this loan or don't settle this property? Okay, so he was buying a $950,000 property for $650,000. Okay, he's going to make $300,000, plus he's got obviously a business in there that's worth hundreds of thousands of dollars as well. So for him to spend $80,000 to make $300,000, absolute no-brainer. And this is why it's much easier than someone saying, oh, the interest rate is 24%. Or someone might say, oh, look, I can get them an interest rate of 12%. But if the originator fee is going to be $100,000, it all throws it out of whack. So that's just, for me, the best way to look at it and to explain it to a client is to look at the full cost. What I put together here is also just a bit of a weighing up the cost of a traditional loan versus, say, a PMA loan. So the first thing you'll notice when we've got the deposit is the bank would only lend based on purchase price. So it'd still have to come up with a 35% deposit. So most banks in a Cat 3 location, in a country setting, on a commercial property would lend around about 65%. So he'd have to come up with a 35% deposit. So he'd have to come up with a positive $227,000. Whereas for us, he didn't have to come up with anything. The stamp duty, lo and behold, the government still gets their taxes no matter which way you do it. So in both scenarios, you're still going to pay $36,000 in stamp duty. The big difference here you'll see is the loan amount. So a traditional bank, like your Big Four, would only lend $422,000, whereas we lent $665,000. Now this makes a big difference in the interest. Because the bank is only lending him $422,000, I've assumed they've got an interest rate there of 6% or 0.5% per month. The total cost of the interest is only $8,645. Whereas because we've lent a lot more and our interest rate is a lot higher, our total interest cost is $53,000. The other big difference is the setup cost. So a bank, and once again, I've been quite generous, they might only charge all their upfront fees and costs might only be $2,200, whereas for us it was $27,000. And that just represents the amount of time and effort that goes into getting the deal done, but also the physical cost of getting a solicitor to actually draw the paperwork up properly. Now, one of the biggest things here and the real deal killer, I suppose, for the borrower was that if he went the traditional path, he would have had to come up with $274,000, which he didn't have. Whereas he did have $117,000 to be able to settle the loan through us. Another big one was the referrer. So if a broker might get paid on a bank loan maybe $2,112, whereas with us, our broker got paid $7,315 at settlement, and this was within 2 weeks of doing the transaction. So the time frame, as I said, for a traditional bank on this type of transaction would have most likely been about 6 to 8 weeks, and he didn't have that. If he had to wait 6 to 8 weeks, he would have lost the deal. He wouldn't have been able to do it. Whereas us, we did it in 2 weeks, and that's from the time that we first saw the application to actually settling and him getting the funds. So the outcome for the client is they basically got the finance and they got into the deal with less than half of the money that they would have required if they went and got a traditional bank loan. And we find for a lot of clients, it's not even about sometimes the cost, it's about how much cash they need to put in. Because even if they had the 275, a lot of clients would prefer to only put in 117 and then use the rest of that money to go and put it into another transaction and make another 300 grand or whatever the case may be. We could settle very quickly. It allowed the borrower to actually reinvest the profits into the business during the prepaid period. So we actually do our loans as prepaid. So for that loan, the amount we borrowed, so we lent him the 665, included his payments for the 4 months. So he didn't have to make any mortgage payments for the full 4 months. He literally just got the money and 4 months later paid it all back in one big lump sum check. Okay, so it's really simple. So just from a serviceability point of view, there's not a lot to worry about because there's no payments along the way. Just as a bit of a side note, the client actually increased the revenue of the business, and he then refinanced out. So four and a bit months later, the client went and got some cheaper finance from more of a long-term lender. Now, a few of the other sort of examples of things we do, completion finance, something we see a lot of where a developer, they're nearing the end of the project and something happens, delay happens or they hit rock or costs blow out or something happens where they need, say, $250,000 to complete the project. They might only need it for 3 months. They've got the pre-sales there and everything's going fine. They just need some quick money and the first mortgagee won't lend them any more money. So the valuation might be $1.5 million. They've got a first mortgage of $750,000. We'd come in with $250,000. The LVR at 67%. The interest rate might be 3% per month for 3 months. Another one that we see a lot of, and it's funny, the amount always seems to be around about the $100,000 mark, is ATO debts. So a lot of the time ATO, they will sometimes enter into payment plans for your clients, but what we're seeing a lot now is they're becoming a lot stricter, and they basically give an ultimatum to the client of, you either pay your ATO debt or we'll start closing down your company and put it into voluntary administration. So this one might be $100,000 they need, might be at 2% per month for 3 months. So really short-term stuff, allowing them to get out of a bit of a problem or settle a transaction, and then you can go and get them refinanced at a more long-term lender. Another one here, as I said, they might have a business opportunity. They might have one of their competitors or some place where they can buy some stock at a really, really good discount, but they've got to settle quickly. They've got to move really quickly. So they might just need a quick $400,000 as a first mortgage against maybe their own principal place of residence, and that might be at just 1% a month for 6 months. I've included this, and you'll actually see this table as part of our product fact sheet you can download from our website, privatemortgagesaustralia.com. And this has some more examples of what we do. So a lot of it centers around urgent funding. As I said, we do ATO debts. We do a lot of refinancing existing caveat loans. So a client has gone out and got a loan at, borrowed it at 5, 6. We've even seen default rates of 15% per month. So we'll a lot of time come in, refinance them out, bring them out of default, and give them a bit of breathing space for a couple of months to give them a bit more time to go and get, the property sold or refinanced or whatever the case may be. As I said before, we'll do valuation, not contract. So we're more than happy. We understand, and we live in the real world where people do buy things that are under market value, and we're happy to lend on that. Paying out a business partner, so someone might be exiting the business, they need some funds there. An urgent business opportunity, they need some really quick funding to go and get some stock or whatever the case may be. Developers, as I said, we do with developers. and also credit impaired. So we're more asset lenders than we are looking at the person. So serviceability and the person's credit is not much of an issue for us. Now, if the person's just come out of bankruptcy and their exit strategy is to refinance, that may be an issue. But as a general sense, we're more interested in the asset. What I want to finish up here before we get into questions, and just bear in mind, if you do have any questions, please just send them through on a note in the little chat box, and we'll answer them at the end. What I thought might be good is just to give you guys a bit of an idea of what we look at when we're qualifying a deal. And this is our first filter. So this is the first thing we look at, whether or not this is something that's going to work or not work. Very top of the list, is it non-coded? Okay, so if it's a mum and dad looking to buy their own home, okay, let's stop there. There's nothing we can do. We can't do coded lending. So if it's a company that's borrowing the funds, or if it's a company or a business purpose, that passes that first check. The other one is, will the client accept interest rates above 1% per month? Okay, so that's the lowest we'll do, is 1% per month. And it's because we only do short-term funding. We're only getting paid for a couple of months. We're not like a bank that gets paid for 30 years on a loan. That they need to understand the cost involved. So it's at least 1% a month. Have a bit of a look at the postcode and the LVR. So depending on where the client's security property is, are they looking to borrow 80% on a farm in the middle of nowhere? Okay, that's probably not going to work. If they're looking to borrow 60% on a 3-bedroom house in suburbia, great, definitely works. Okay, so that's what we look at. Is it going to stack up and meet the postcode restrictions? Another one we say is, how much does the referrer want to make? So you as the introducer or the broker, how much do you want to make? Okay, so that will then dictate how much we charge as the origination fee, or we can just mark you down as mandating directly. The next one we look at is the exit strategy. So this is how the client is actually going to pay the loan back. The most common one we get is refinance. So they use us for a couple of months and then they refinance to one of the big four, and they use that for moving forward. Another one might be the sale of the property. So they want a couple of months up their sleeve to just put the property in the market and sell it on their own terms and get the price that they want. So in this regard, serviceability is not required, because we do prepaid loan terms. So there's no payments along the way, so it just makes it really simple. We're more interested in the asset. Another big question we ask is, why can't the client get bank finance? Okay, it might be that bank can't settle quick enough. It might be some credit blemishes. It might be that they don't have enough pre-sales. There's a huge list, but we want to find that out, because if the client can get bank finance, don't use us. It's not what we're there for. It's only when they can't get it that we'll come in and help out. And the last one's probably one of the most important ones, is, when does the client need to settle? Okay, we really like to set up front, when do they actually need the funding by, so that way we can make sure we're working to a time frame that's going to get them the funds when they need it, rather than setting them up for failure. Now, one of the, I suppose, the job of the referrer or the client, especially if you've never done any private lending, is around educating the client. And the biggest thing, I suppose, hurdle that people look at is the interest rate, and think, oh my God, I'm used to interest rates being 5%, 6%. How come I'm paying 2% a month, which is 24% per annum? And as we went through before, the best way to do it, and I reckon the most prudent way to do it, is to look at the total cost rather than the interest rate. So if you've got a client that needs $100,000 and they only need it for 1 month just to settle a property, the cost of that loan might be $2,000, okay, which would be 24% per annum. So if the client looks at it and says, well, if I need $100,000, the cost is $2,000, okay, that makes sense, because I'm going to settle this property, I'm going to go and make $50,000 or $100,000. Or it might be, hey, I need a $100,000 loan because I need to settle this property, and if I don't, I'm going to lose my 10% deposit. I'm going to lose $60,000. Okay, it starts becoming a bit of a no-brainer to spend $2,000 to either save $60,000 or to make $100,000. So that makes it a little bit easier for the client to understand the total cost and the benefit of the loan. Because sometimes I've got here the client's expectation is that they're going to pay 5% per annum, and they're only going to get charged $416 interest. And the reality is that no lender is going to do all the due diligence and lend someone $100,000 to only make $416. It's just not worth it. Whereas a bank who's going to be getting that money every month for the next 30 years, of course it makes sense, okay, because they've got more of a long-term sort of outlook. So the biggest thing is it's all about the short term, and letting them weigh up the cost of what are they going to gain by doing the loan, or what are they going to lose if they don't do the loan. And that really helps a lot of clients get over the line and just sort of see the benefit of it, and that it's not all about the interest rate. Last two slides here, I just want to sort of borrow or beware, and once again, this is only if you've never done any private lending, and just to look at what some other lenders do in the marketplace, and just to be aware of it. What a lot of them do is these from rates. So they might say, oh, we do rates from 1% per month or from 2% per month, and it sort of implies that there's no other upper limit. And so they might, you know, if they say, oh, we've got rates from 1%, you might put an application in hoping that you're going to get 1% per month. And I've seen it where they'll say 1% per month, and then they put all the loan, they go all through all the process through, and then the rate comes back and it's 6% per month. Like you never know what the rate's going to be. So just be very careful of these from rates. Another one that's probably my biggest bugbear in the industry at the moment is these big upfront fees before they get the final offer. So where they get the client to commit to pay, and I saw one the other day, it was $18,000 whether or not they did the loan. So they're committed that before they've even seen the final offer, that they're up for all these fees and charges before, and they don't even know if they're going to get the money. So just be very wary of that. That's why we only ever charge a small $550 to $770 upfront, and that's it. If the client doesn't like the offer, wants to walk away, there's nothing else they need to pay. There's no charging clauses. The other one we see a lot of, especially around the caveat loans, is the 24-hour loans. To get a loan done in 24 hours is a phenomenal amount of work and things that need to come together. What we see a lot of is clients who go into these loans and say, yes, I want the money in 24 hours. They get so committed to doing the process that the next day when they say, we need another 24 hours or another 24 hours, they're committed, you know, they're pot committed into that situation, that I often wonder how many loans actually get done in 24 hours. Not the one they've done out of 1,000, but it's a great question to ask is how many of your loans actually settle within 24 hours. So just be wary of that. The other one we see is very expensive valuation for forced sale. So rather than doing it for market value or even for mortgage purposes, they'll do a forced sale valuation, which, you know, typically comes in well under market value. And what they then say is they go back and say, well, the LVR doesn't stack up, but hey, you still owe us all the upfront fees and charges. They'll then even have a cancellation fee, which might be a couple of %, and they've got a charging clause in their indicative letter of offer that says basically if you don't pay, we're going to charge and put caveats over all your property and your PPSR, and we're going to hold it to ransom until you pay our fee. So just a few things to keep to be aware of. Just be very skeptical and wary of big upfront fees and charging clauses in indicative letters of offer. So this is the PMA way. So this is the way that we do it, and our slogan is that we do cleaner loans for better results. Okay, so we don't like these quick, nasty, dirty loans. It's all about a really clear and transparent process with you and the client to make sure we get the best result. At the end of the day, we want repeat clients, and we want people to come back. We want people to have a good experience, because we know ultimately that's going to lead to great word of mouth, and we're going to get a lot more people coming back. So the way we do this is we do low upfront assessment fees, which we've spoken about. We have no charging clauses in our indicative letter of offer. We have no cancellation fees either. All valuations are done at cost. They're also done at a reasonable value, and they're released to the client. We have capped interest rate ranges, so you know that if you're applying for a second mortgage, the interest rate is going to be between 1.5% and 3.5% per month. And we will tell you where we think it's going to lie in the indicative letter of offer. So there's no surprises to the client. We rebate any unused interest on extension payments. So all of our loans come with a prepaid period. So it might be for 4 months. We always give our clients an extra 6 months worth of extension payments. Okay, there's no extension fees or charges. The only thing they need to pay is 1 month's interest in advance to push the loan out by another month. So that just gives people a lot more flexibility to extend a little bit if something happens, a delay happens, which, as it does in life, things happen and people need a little bit of extra time. So there's no rollover fees or extension fees, they just pay that interest. Now, what we find is that someone might need to settle and they only need two weeks of until the settlement of the property is going to go through. So they might pay 1 month's worth of interest and then they settle 2 weeks later. We'll rebate any interest they didn't use. Okay, so we don't charge interest for a time they haven't used. The other thing we have is we've spent a ridiculous amount of money custom building some software that is specific for us, so we can actually process deals a lot quicker than anyone else in the marketplace because it's all automated. And that's how we can get out our letters of offer and loans through extremely quickly because we've got that custom built software there. We have a high level of repeat customers. Okay, we're not like some of the lenders who have one customer who never wants to see them ever again. We've had customers come back 2, 3, 4 times because they can see the value of what we're offering. And we have a very much a win-win approach to lending. So guys, look, that's it from me. Look, we do have a little bit of question time now before we finish up. I'm just obviously conscious of time. If you do have any specific loan scenarios or something you want to run past, we actually give our referrers direct access to our National Credit Manager, and that's Peter Cuskelly. You've got his mobile there, that's his direct number and his direct email. Peter has over 30 years of banking experience. He's an absolute gun and knows the industry inside and out. And so if you've got any quick questions or things you want to run past him, give him a call or shoot him an email. That's what he's there for. So don't be afraid to run some scenarios past him. Now, if anyone's got any questions, please just pop them in the little box. Otherwise, I'll assume I've just answered absolutely every question that you guys could have possibly happened. But otherwise we'll leave it there. Now we will be making this recording available and we'll email it out, so if you'd like to just recap over something. Otherwise, yeah, if you have any specific questions, please either ask them here or shoot us an email and we'll be able to answer them from there. So guys, I think we might leave it there just because I'm conscious of time. Guys, thanks for attending. We will send out some certificates for those that attended for your one CPD point. Yeah, please stay in touch and we look forward to doing some business with you soon. Thanks.